Well, the man drinking water is Sean Peche. Lovely to be with you, Sean, today on this special podcast. We've had a good sign up, more than 100 people in the room. Lovely to see that, and growing all the time. Sean is based not here in South Africa, but you spent much of your life in South Africa. How long? Just by way of background, just give us a little thumbnail sketch of your career.
Yes, good morning, Alec, and thanks very much for the opportunity. It's good to be here. A thumbnail sketch. I grew up in Cape Town. I went to University of Cape Town, then started my and to Deloitte, where I qualified as a chartered accountant. Went to Old Mutual, spent a few years at Old Mutual, and then joined a company called Decillion, where we started a hedge fund, one of the early hedge funds in South Africa, the Big Rock Fund. Ran that for a few years, then came over to the UK with a good friend and ex-colleague Richard Pitt, where we set up a hedge fund over here. That was in 2000. And then, 2001. And then I left and joined Orbis, where I spent a wonderful 5 years with some fantastic people, including the late great Simon Moreira. Had the privilege and pleasure of working with Simon, and also the late great Mr. Alan Gray, and then left and started Ranmore in 2008. So that's, and I've been here ever since. So that's a whistle-stop tour, and along the way I did my CFA charter.
Fantastic. And before we launch into the presentation, just to let you know that Sean will be guiding us through his views, and he's got some very interesting charts to share with us for about 20 minutes or 15 to 20 minutes or so. We do, though, have the capacity to field questions, which is what this is all about. And our general manager here at BizNews will be giving us some insight on how we do that, won't you, Mr. Lohman?
Excellent. Thanks, Alec, and welcome, Sean. Just quickly, before we look at the questions, can you hear my voice and see Alec and Sean on screen with a little presentation? If you can, there's a little high five button on your control panel, just so that I know the tech is sorted. Okay, I see a few high fives coming through. That's excellent. Thanks for everyone. As Alec mentioned, we do like to keep the webinars conversational. There's a little questions drop down on that same control panel. If you put them in there, Alec can pass them on to Sean as he runs through the presentation. We have a nice little conversation, but thanks, Sean.
Yeah, and that's important that you do have put the questions. We've more than 150 people in the room, and it's still growing. So there will be lots of questions, doubtless. The earlier you can pose your questions, the quicker we can ask Sean to answer them. But it's all about value investing. You mentioned the late Alan Gray, and of course the late Dr. Simon Moreira, who Sean and I both had a very, very warm relationship with. I'll tell you a little story there, Sean, before we get into the context of things. In 1998, when Alan Gray Investments in South Africa was really a small firm, they were out of favor. It was the .com era. Simon started to come on radio with me. I discovered him somewhere. I can't remember how we met. And every Wednesday night for a few years, Simon would give us his homespun wisdom, almost like a Warren Buffett of the Karoo or of the Flactors. And my goodness, did he resonate on that program. And Alan Gray, as a consequence, just because people could see what Simon stood for and his common sense approach to life and to investing, grew and grew, and today we know it's a massive international firm. But from that perspective, he was always Mr. Value Investing. He was always the guy who said to us that this is you got to be common sense, and in a way, that's what value investing I think is about. But you're an expert in the field. You learned at the feet of one of the masters, if you like. What today value investing is kind of out of fashion. So just to maybe tee you up for the presentation, tell us a bit more about that, about what is value investing, maybe to start off with, and why is it relevant today?
Well, Alec, I absolutely agree with you, and I think both Alan and Simon were highly intelligent people, but they had a real knack of putting things across in a really simple way, in the same way as Warren Buffett does. And if you look at value investing, I mean, essentially it's just buying something for less than it's worth. And I'd argue we're all really value investors. Everybody likes a bargain. If there's a special on holidays, you might want to take advantage of that and go on holidays, or buy a car close to quarter end and get the same car, but just at a better price. And so that is really what value investing is all about, just trying to buy something for less than it's worth. And the reason being, well bought is half sold. If you buy something at a good price, you're basically halfway to having sold it. Whereas if you buy something at the top of the market or whatever, things have got to go really well for you to get your money back. So if you compare them, growth investors are focused primarily on earnings growth, and sometimes at any price. And quality investors are focused on the quality of businesses, return on equity, cash flow, margins, those types of things. Of course, they're not mutually exclusive. I mean, we as value investors, of course, we want to buy quality. Who wouldn't want to buy quality? Who wouldn't want to buy something that's growing? We just don't want to do it at any price. And the reason we don't want to do it at any price is that is how we try and minimize the risk of a permanent loss of capital. And so that's all value investing is. And it's nothing, it's nothing esoteric. It's a timeless concept. And so that's what we do.
So it is really common sense. Getting back to what we were saying earlier, Warren Buffett has always told us that we have a margin of safety in anything that we purchase, because we might be getting our calculations on the value of the company wrong. So give yourself a 20%. He spoke about, I think Benjamin Graham was even bigger margin of safety than that. And then when it comes to time to sell the investment that you made, you at least going in at a low level. So, all right, Sean, you got a presentation for us over the next few minutes. Let's kick off with the first of those slides, which, well, we've just seen that. Is there anything more you want to talk to this?
Well, I think the reason you want a margin of safety is things change, and things change for all those. Let's just think in terms of COVID, what's happened in the last 6 months. Arguably, shopping centers are worth a lot less today than they were at the beginning of the year. You could say the same thing for airlines and cruise ships. So businesses change, and the price and value of things also change. But that is not only for value stocks; it is the same thing for growth stocks. And so we have seen that forecasts have and conditions can change very rapidly. And for that reason, one has to be very careful about how much you pay for future growth, because likewise, things can change for those companies too. And there's lots of examples of those.
Brilliant. Okay, so let's talk to those forecasts. And you got a lovely story there about BlackBerry.
Well, so the first thing here, what you're looking at here is the blue line is the share price of BlackBerry. And the orange line, which is a bit stepped, is the earnings per share for BlackBerry, and that's on the right-hand side. And if you go back to the early 2000s, I mean, BlackBerry really came into its own during, sadly, 9/11, when everybody was using their BlackBerry to message people at the top of the towers. And so, yeah, at the time, and then in 2009, BlackBerry had half the US smartphone market. You can see that in the lower left chart, 55% of the market compared to Apple. They were growing subscribers. People were getting very excited about the total addressable market. At the time, only business people used BlackBerries, but he could expand that. And so earnings grew. And right at the peak, they launched the BlackBerry Storm. And BlackBerry Storm was the first touch phone, etc., the touch screen phone. So everything was going well for BlackBerry. And people at the top, if you had the misfortune of buying BlackBerry, you were paying 42 times forward earnings. Earnings continue to grow, but wow, you've lost most of your money, 95%, because along came Apple. Just when everybody thought BlackBerry was impenetrable, had the touch screen, had the security under control, etc., along comes Apple with a slightly better product, and 12 years later, BlackBerry is nowhere to be seen, really. And so that is the first challenge, is that one has to be very careful about being so wedded to your forecasts, because forecasts change, and they certainly change when there's competition. People looked at BlackBerry, saw how well they were doing, and thought, we can do that and we can do it better, and along they came and did.
Great, good story. You have Microsoft on the screen now. The challenge of overpaying for quality.
Well, I mean, Microsoft, is there a better quality company if you think about it? Annuity income, wonderful cash flow, embedded in businesses around the world. And if you go back to 1999 to the tech bubble, back then earnings were growing. You can see again the orange line was sloping upwards. Earnings were growing, and you paid $40 for Microsoft. It was a forward multiple of 34 times, and your forecasts of growth would have been right, because ever since then, Microsoft over the long term has grown earnings substantially. I mean, earnings per share have grown from around 80 cents to $6. But the problem is that for 14 years, Microsoft's share price did nothing. In fact, at one point in 2009, in January 2009, the company was in 7 times earnings, and you'd lost more than 50% of your purchase price had you bought it at the wrong time. And so here's an example of a highly, a company that is just of impeccable quality and was forecast to grow and had market share dominance, etc. And yet, because you overpaid, it took you a long time to get your money back. And so that's the lesson here. I mean, who doesn't want quality? Of course, we all want quality, but don't overpay for it, because it might take you a long time to get your money back. And that's what happened with Microsoft. You have to be patient for 14 years. And of course, at the bottom, you would have worried about Google and its free products. Were they not a threat to Microsoft? And so it would have been challenging to stay the course.
Such an interesting graph there. If you'd held on for the whole period, since even though you bought it at the peak in 1999, you'd still be looking pretty today.
You certainly would, but we only know that with hindsight, because if you'd held on with BlackBerry and the same thought in mind, you would have been looking pretty terrible. And so one only knows who the winners really are with hindsight. We can think that they're going to be winners, and they might end up being winners, but that doesn't always play out that way.
There's your next graph. How has value done?
So the question is, and we've obviously seen there's lots of articles doing the rounds in recent months and years about, well, value is finished, it's an outdated philosophy, etc. And I might point out that those same arguments were made at the peak of the tech bubble in 1999. At the time, you'll recall, it was all about eyeballs and clicks, not bricks. So those same arguments were put out to the market. Of course, what's interesting for me, what you're looking at here is the green line is, had you invested in the MSCI World Value Index in October 1980, your $100 would be worth 3,100. And had you invested in the growth index back then, your $100 would be worth 3,263. So pretty much neck and neck, and you've returned 9% and 9.1% respectively, compounded through that time, well above inflation. And so the problem is not that value strategy has destroyed wealth. It hasn't. It is just that in recent years, it has substantially underperformed. And if you stop the clock along the way at various points in time, you'll see that there's some, post the 2000 correction, value substantially outperformed. There we go, where your cursor is there, far more than growth. And if you look at the vertical red line, in 2000, at the end of 2017, had you invested in those strategies 40 years ago, in 1980, value strategy would have been 10% and 8.7% for growth. So as with these performance charts, it always depends on where you stop the line, where you start, etc. And the key thing for me is just invest in a strategy that you think makes sound fundamental sense, rather than trying to back the horse that won the last race, I guess. But what is interesting is we'll go through a few charts now from that point, from the end of 2017, because you will see there things corrected quite a lot. Value underperformed and growth substantially outperformed. And the reason is, the question is, why has value underperformed recently? And there are a couple of reasons. Firstly, earnings, as we will see, have driven share prices. That is why Microsoft's share price went up, and that is why BlackBerry's share price collapsed, because earnings collapsed in the case of BlackBerry, and they grew strongly in the case of Microsoft. And so for many of these companies, these are the top 10. These are the contributors to the MSCI World Index return, okay, since beginning of 2018. Now, what you'll see there is there are nearly 1,900 companies in the MSCI World Index. 80% of the return has come from 10 companies. And if you look down the list there, Apple, Microsoft, Amazon, etc., all of them have been rapidly growing. In fact, it's quite staggering to think that Apple, which is only now 4% of the world index, contributed 24% of the entire world index's return alone. So yeah, earnings drive share prices. Those earnings have grown for many of those companies, and none of those companies really have been in the value index. So that is what the challenge is, and that is why value has underperformed. Yeah, the next chart is quite interesting in that the question is, well, let's take a reality check, because what about now? Now what you'll see here, so the blue line again is the share price. The brown dotted line is earnings per share, and this is Apple. And you can see that for most of history, the blue and the green line is free cash flow per share. The blue line, share price, traffics around the earnings. As I said, earnings drive share prices, except from the point of 2018, which is the vertical light blue line. Okay, so I hope that's all clear. Where the share price has just become detracted, it is just separated from the trajectory of the earnings growth. Earnings per share have basically gone from that point, just under $3 and are expected to be $4 in a couple of years' time. But the share price has gone from 40 to 113. So the share price has tripled and earnings haven't tripled. And if you're buying the index and if you buy Apple today, you are buying at the red arrow. That is where you're buying. So you better hope things actually accelerate from here on an earnings perspective, because if there is a if there's a misstep, well, there could be quite a correction at play. So that is the first point. And the next point, which I think is quite interesting, Alec. If you just go to the next slide there. Yeah, the next slide. Is that, and what this is Facebook. Now, this is revenue growth for the latest quarter, okay? And this is quarterly going back to 2014. And again, the blue arrow is at the beginning of 2018. Now, you can see there, the growth is on the right-hand chart, is that revenue growth for Facebook for a few years beforehand had been above 40%. So, and that is no surprise that the share price, which is the black line, grew accordingly. What's interesting, though, is since then, revenue growth has been slowing. And so the perception out there is, well, technology companies, they're the future, there's only one way to bet, and that is with these tech companies. Interestingly, revenue has been slowing. And this is the same for Google, it's the same for MasterCard, it's the same for many of these companies. And the question is, well, why? Well, these companies are large companies now, and they're not immune from what's happening out there in the world. And when you look at the number of retrenchments and companies that are retrenching employees out there, those people all use computers. They probably all have Microsoft licenses. The businesses are under stress, and so they're advertising less. There's more competition these days. In the past, you had to advertise on Google or Facebook. Now you can choose to advertise on TikTok or Snapchat or any of those other, Pinterest, etc. So what's interesting for me is that revenue has been slowing, yet the share prices have carried on going and have carried on higher. And the question is, well, why has that happened? And I think in the next chart, it shows you, I think one of the big reasons is that we've seen this huge surge in ETF demand. People have given up on active managers, and they have said, we're going to just invest in the indexes. And so what that has meant is that the money that has flowed out of active managers into the indices has gone to the largest companies at the very point in time when the largest companies are the Facebooks, Microsofts, Googles, etc. And so that, I think, is one of the major reasons which has caused the separation of price and fundamentals. And we'll have to see how that plays out. But it's bearing in mind that today, if you invest in an ETF, the largest component of your money is going to go to technology companies, and just at a very point in time when revenue is slowing and earnings.
Sean, there is a question that is related to this from Shaman Prem, who says, how would you determine the intrinsic price of an ETF?
Well, ETFs are, ETFs are just, what they do is, it's just you're buying it at the market value for the underlying holdings. And so as every day, as the underlying value of those shares that are in whatever ETF you're in, change, you know, that market value is included in is included in the calculation of the ETF underlying price.
I guess he's yeah, I guess he would be looking at something a little different. And I presume that this is almost impossible to do, but you would have a look at all the constituents in the exchange traded fund and then work out your own intrinsic value for them and then try and calculate that. But the way you've explained it, just a net asset value, is probably the only way you really can look at that intrinsic value of it. And that would be determined by the way the share prices react.
Yes, and I think one of the challenges is that if you decide, okay, well, value is the way forward, I'm going to go and buy a value ETF. We need to understand what is in those value ETFs. Well, a large component will be financials, and a large component of the financials will be US banks. And then you have to say, well, do I want to own US banks when the US is going into recession? I've got shale debt, credit card debt, auto loan debt, etc. So it's you know, quite often to chase history and look in the past and say, oh, ETFs have beaten active managers, I'm buying an ETF. Well, that will work if the future is the same as the past. Well, I think in the last 6 months we've seen that the future is not going to be the same as the past, and that's
okay. Are we ready for the next one?
Yeah, we're ready for the next one. Thanks, Alec.
Okay.
So here's an example, and the reason I chose this example is there's a perception out there that value investors, they only invest in steel mills and boring old paper companies, etc. And actually that's not true. Well, certainly it's not true for us. And one example I thought was, let's compare eBay to Amazon. Now, the beautiful thing about eBay is that it does, because the items are shipped directly from the seller, they don't need warehouses. They don't need fleets of aircraft. They hold no stock. They bear no delivery cost. And Amazon, one should know that Amazon, although the perception is that Amazon's doing well because everybody's buying parcels and watching Amazon Prime, most of Amazon's money is made by AWS, which is their Amazon Web Services. Okay, so and so if you look at eBay, they also have lower regulation and tax risk. A lot of the governments out there are trying to work out, certainly here in the UK, how can they tax Amazon better? Because of their structuring, what's happening is that the stores on the high street are closing because they are being out-competed and outpriced by Amazon, who are able to have certain parts of their operations offshore. So you look at eBay and you look at Amazon, the free cash flow for eBay is incredible. They actually, they generate 9 billion of free cash flow, and Amazon generates 3 billion of free cash flow. Amazon generates 24 billion. And so if you buy eBay today, it's on a free cash flow yield of 8% versus Amazon's 2%. And the difference is that you've got lots of share options. Amazon employees is one of the largest ways that many of these tech companies remunerate their employees is via share options. And actually, I did some sums recently, and I worked out that the large tech companies, there are about $260 billion worth of share options that could come out onto the market over the next few years. I mean, that's a staggering number. Even if you look at Zoom, which is worth 139 billion. I mean, employees have got share options there worth $7 billion, and that's more than Zoom's revenue it's ever generated revenue in its existence. So these are staggeringly huge numbers. Whereas eBay is buying back stock. So, and you'll know that eBay did a deal recently. South Africa, or Prosus, was very interested in their classifieds business, and they did a deal with Adevinta in Norway. And so, valued investing doesn't have to be, boring old industrial companies. It just means you're not paying a crazy price for a decent business that's growing. And so that's an example of eBay. That's why I wanted to put it in there. Our largest holding in our fund. So I guess in summary, Alec, before we deal with all the questions, I think that getting value for money is a timeless concept. It is not outdated. It is not dead. Value has returned, inflation beating returns over the last 40 years. Of course, the numbers will differ depending on your starting and ending point. But right now, we're at a point where I think one has to be careful of chasing recent history, because the future is unlikely to be as the past was. And that for many of the large companies, which are well owned and commonplace in most large funds, those companies are expensive, those earnings levels are high, and those earnings expectations are high. And if there is a disappointment, it could be a long way down. So that's really what I have to say, and happy to take any questions.
Oh, there are lots of questions to come. I'm just putting your disclaimer up there. And to add to that, before we hit the questions, Sean, I learned a very good lesson about this when I listed MoneyWeb in 1999. I'd go down to Cape Town, where most of the asset management companies were. In fact, you were there at the time in Cape Town, and give a presentation on this really small little internet company, and have a packed room from Sanlam Mutual, anywhere that you could imagine. You'd have 10, 15, 20 people in the room pinging questions. How are things going to change? Where does the, where's the internet going? As if I had a clue. But the share price came on R2 a share. In fact, got a R2.10 on the first day. We offered them at R1. It wasn't a year later, I had Old Mutual offering me shares at 18 cents. So to look at that, okay, admittedly it was a dot-com bubble, and Old Mutual probably had a lot of outflows, but things can change dramatically. And when that happens to you personally, you tend not to forget that. Session Munsami puts a question here. He says, as a new investor, sorry, before we go to Session's questions, Stu, do you want to just update us again on how to pose the questions?
Excellent, thanks, Alec. Yeah, just on the control panel on the right-hand side, there's a little drop-down menu. It's got questions written, and there's a little question sign as well there. If you just put them in there, please write them in, and Alec will pass them on to Sean as we go through.
Brilliant. Session Munsami says, as a new investor, I better put my camera on now, Sean. So we've had enough of your disclaimer. Okay. What would a solid ETF be to invest in? Are there value ETFs that you'd like?
Well, I mean, there are value ETFs. To be honest, I spend more time I don't spend any time looking at ETFs. I spend all my time looking at stocks. All I would suggest is that before buying an ETF, in the same way as you buy a company or you buy a fund, understand what's in there. And more, that I would suggest that is more important than just looking at a number and just saying that one did 15% and that one did 8%, therefore I'm buying that one. Because how did they get the 15%? What generated the return? Was it because the fund owned Zoom, etc.? Who knows? So that's what I would suggest. I think one of the pitfalls, again, as I mentioned with the ETFs, is just the value ETFs is just the makeup of them, and that they have a large component of financials, of which a large percentage would be value. It would be US banks, and that might not be where you want to be.
Okay, so just know what it is that you're buying. Sean Griffiths, your namesake, says, can Sean explain the difference between ETFs and index funds? What's his view of index funds?
I mean, essentially they're the same thing as far as I know. Yeah, I mean, so that's pretty much all I have. Yeah, they're the
okay,
same.
So you don't really care. You're looking at individual stocks, and well, whatever. Yeah. Let's move on to more interesting questions. Rory O'Donnell, sorry, Sean, I didn't mean that in a bad way. Says don't. No, that meant to the other Sean. The other Sean. Mm-hmm. Rory O'Donnell says, don't most successful growth stocks become value stocks, hence the convergence over time?
Well, it depends what they're intrinsically worth. I mean, is BlackBerry a value stock? I mean, Polaroid, a lot of Kodak, those things were growth stocks in their day. And I think one has to be very careful about buying growth stocks that go ex-growth. And the reason being that there are a lot of investors. I mean, the worst stocks, I think, are the ones where the growth investors are leaving, but the value investors haven't arrived at the party. Okay. For example, let's look at, I mean, one example out there, I don't know if you followed the story on Nikola, which is this truck company that's got no revenue, that did a backdoor listing, and it turns out that their image of, well, they're trying to create a hydrogen truck of their truck driving was actually just pushed down a hill. I mean, it's a big story out there, and that thing was worth $30 billion with no revenue. Now, the growth investors and the people who were enticed into that story are leaving. Value investors are nowhere to be seen, and so that's the problem. When growth slows, you're looking over, you're like the road runner in those old cartoons. You're going over a cliff because there's no buyers in sight, and that is the challenge. Stay away from those companies.
But Nikola was a giveaway, wasn't it? I mean, what a ripoff of Tesla. Nikola Tesla? Okay, they got Tesla, so we'll call ours Nikola. Ah, really? It's just a and was it the CEO who got arrested or chased out, or just it's really buyer beware.
Buyer beware, Alec. And I mean, in fact, I did a little calculation just before coming on air. I just looked at Zoom, and I compared it to Sibanye. And we have Sibanye in the portfolio. In fact, it's one of the 2 South African stocks that we own. Now, in the last 6 months, Sibanye has generated free cash flow of $634 million. And I would say that Neil Froneman's been an incredible value investor, because he has amassed these unwanted assets, which have cost, I think he's paid sort of $40 billion Rand since 2011, buying these unwanted assets. And the company is now worth 120 and made 10 billion in the first 6 months. Right, but let's come back to Sibanye. 634 million of free cash flow in 6 months. Zoom generated 624 million of free cash flow. So pretty much the same numbers. Zoom is worth 139 billion. Sibanye is worth 5.8. Okay. So and then if you say, well, in a year's time, are we all going to be using Zoom? Maybe we're going to be using Facebook's product or Google Meet or whatever. I know from our perspective, we used to use Zoom. We're now using Microsoft Teams. So who knows what we're all going to be using in a year's time? How would I get my 139 billion back? Whereas in 6 months' time, we're probably all going to be still going to be buying platinum and gold. And so, again, it comes back to just invest with an asset manager and a fund manager you think makes sense, rather than just the numbers, because the guys who own Zoom will have done better than the chaps who own Sibanye.
But the point that you made there, Zoom is worth 139 billion. Surely it's priced at 139 billion. Might not be worth that.
Totally, I totally agree with that. Sorry, quite correct.
Mr. Market. Mr. Market makes mugs of all of us. So there's Chris Edwards, and his question is, according to your thesis, there's a problem if too much money flows into the index funds. However, 80% of fund managers in any market underperform the index. Don't you think the market therefore needs both passive and active? There we go. This is the argument that had to raise its head, Sean.
Absolutely, I think the market does need active and passive. And the reason being, our job as fund managers, really, if you look at it, is the allocation of capital. That is what we have to do. Allocate capital to businesses that are requiring capital and that are growing, and we're allocating people's savings. And ETFs, all they're doing is they are just allocating money to the largest companies. That might be fine, but it might not be fine. And so it's a bit like a driverless car, I guess. The ETF is just a driverless car, and that's fine if you're driving in well-mapped roads. But if you're driving in unmarked territory, such as now, post-COVID, I would argue, maybe that's not the time to be climbing in an autonomous car. And you have a decent driver or decent pilot at the wheel.
I interviewed Magda Wuzikcha a couple of weeks ago from Signia, and she said no active managers have ever been worth investing in rather than passive investment. So I guess there's two sides to every argument. It does, however, I like the point you make about the autonomous or the driverless car going into a new environment, because that's very much what we're doing right now.
We are, and I know, I mean, it's been hard. You've seen there as an active manager, and you're sitting here and you're trying to rationalize why everybody's buying Zoom and why people are buying Nikola, and you can't come up with a rationale and a reason. And so we just tell our clients that all we're going to do is we're going to invest what we think makes sound financial sense. And if the market does other stuff, well, then the market does other stuff. We're not going to participate in the craziness. And so to look back and say, well, yes, active managers haven't beaten passives. Of course, it's been hard. I mean, Apple, 24% return. And so that's history. Let's see what's going to happen in the next 10 years.
Okay, well, we're going to disagree on that one, but we are an Apple shop here at Biz News. We are Apple shareholders since it was 126 before the share split, dollars a share. So we've done very well out of it. And then we believe in the ecosystem. And I think that's really where Apple looks so exciting. We're starting to get quite a lot more questions. And I must warn you guys, there are more than 200 people on this webinar. If you want Sean to answer your question, please post it now, because it's very likely that we will run out of time otherwise. Again, Sean Griffiths is back. He says, are there value index funds?
Well, I mean, there's certainly value ETFs, and yes, you're welcome to go and have a look, and there's certainly and buy those. But all you need to do is search. They will be smaller. They'll be smaller than the growth and the momentum ones, because there's been less demand for those. And the definition of value does differ from MSCI, and it differs from to Russell as to how they determine value and which companies form part of that index. So yes, they will. And also the other thing, Alec, which is quite interesting, is that obviously in the US there's a lot more liquidity. In Europe there's far less liquidity, and so those value ETFs in European value ETFs will come at a slightly higher cost, because to make up for the liquidity.
Peter Pinar wants to know, Sean, he says, which industries globally, in your view, are going to be the best from a growth point of view in the next year?
Well, the growth in earnings or growth in share price. So I actually think, I mean, we have nearly 25% in consumer staples. And just to highlight, we owned Google. Google was our largest holding in the fund back in 2017. And the reason we owned Google back then is it was cheaper than any consumer staples we could find, especially if you looked on a cash flow basis. Now we think that's the reverse. And actually, if you look at companies like Kroger, food and staples retailers, Kroger and Ahold in Europe, or Metro in Canada, those food companies.
Not Metro Bank. Not Metro Bank. Okay.
No, Metro and Empire in Canada, those food retailers are doing well. And why are they doing well? Well, they're doing well because people are not eating out of restaurants. And in tough economies, you might not be, if it's a tough economy and it's a recession, we might not be buying electric vehicles, but we're certainly going to be buying food. And so now there is, you've now got footfall back into those food retailers. Their online businesses are at scale. They don't have the wage price inflation that they had a few years ago when employment was full. And because there's such high demand, the promotional offerings are less. And so companies like Kroger and Metro and Ahold are growing earnings rapidly. But what's interesting is if you look at the food and staples retailers, make up 1.45% of the S&P 500. So if you think you're going to get exposure to that theme in a S&P 500 ETF, you're not. And so that is why one has to, that's one of the reasons why I think active managers certainly make sense at this point in the cycle. And so I'm particularly excited about food and staple retail.
And I think you've now also just worn on your sleeve why you don't like Apple, because I can hear that Microsoft jingle in the background coming through every now and then. We don't get that on Apples, Jamari, Peter, so I hope I've pronounced your first name correctly, Jamari, says, sounds like they don't see a lot of opportunity. Where do you put your money today while you're waiting for the future?
Well, I mean, first of all, diversification is absolutely important, because the main thing, if you read all these books and and there's a great one at the moment I highly recommend called The Psychology of Money. It makes the same point. The important
Show it to us, Sean. Show it to us. You got it right there. I know you showed it before we started. Okay, screenshot time.
Absolutely brilliant, and thank you to a few friends of mine for recommending that to me. But the important thing is to stay in the game and to be diversified. Okay, and so again, if you want to invest in an ETF, make sure you're in an ETF that is diversified. It doesn't have 20% in one or two companies, because you're very, very exposed there. And so that's what I would do. Who knows what the future is going to hold? But the best way to stay in the game is to be diversified. And one of the there's a saying that the only free lunch in economics is diversification. And But you want to have that fine balance between being diversified so that you diversify your risk, but not being so diversified that you don't get any return. But these are going to be challenging times, and so that's what I would suggest.
John Hardy's question is, what are the best value stocks in the UK at present? Would shares like BAT, Fevertree, Meggitt, Next, Whitbread be value stocks?
Well, interesting question. And I mean, the one benefit that we have and why I like the global strategy is that even if you're in a certain country, you're not hamstrung to just selecting those companies. I think if you look at in the UK, many of the large companies are banks, and banks are geared players on economies, and the economy is going to be challenging. So the UK stocks that we own, so we own Morrison's, which is again a food retailer and a similar play to that, and interestingly, have got a relationship with Amazon. So who knows? Maybe one day I'll wake up and find that Amazon has bought out Morrison's in the same way as they did with Whole Foods. Complete and utter speculation, but at least they've got a relationship there and can benefit from some of their growth. We haven't owned British American Tobacco for many years. Interestingly, that company I think did a bad deal buying Reynolds. And one of the problems, or one of the challenges for value managers is we are totally reliant on, if the market doesn't recognize the value that we think we see, we need management to recognize that and to buy back stock or unlock value in whatever way. But British American Tobacco went and bought Reynolds on 25 times earnings, saddled themselves with 50 billion pounds of debt, and now you've got a time when no one's traveling through duty free, etc. And so there's a vital source of revenue is under threat. And then you've got vaping, which is some 80%. It's 20% of the price to vape rather than to smoke. We have a very small position. Yes, Alec.
Sorry, you're not allowed to buy BAT for another reason. You're married to a medical doctor. I don't think you might get divorced pretty quickly if you go and buy a cigarette stock. Certainly from the way I hear the doctors think about smoking.
Well, look, I think that is right. We do have a very small position, which we initiated very recently, actually, in Imperial Brands, which doesn't have the same level. Have you told her? No, I haven't. And I hope she doesn't watch this webinar because I could be in trouble.
Sorry, you were talking about Fevertree, Meggitt, Next, Whitbread?
Well, Fevertree did really well because of gin and the tonic waters, they had elderflower tonic, and so they really rallied off historically off the back of the popularity of gin. Well, of course, it's more expensive, it's more exclusive, so you would have it when you go out to a bar and restaurant. Well, fewer people are going out to bars and restaurants, so if you're going to have a gin at home, maybe you're going to have the Morrison's or the Sainsbury's gin, Sainsbury's tonic water, and so that is one of the challenges. And it's one of the challenges facing companies like Diageo is that people are not sitting at home drinking Grey Goose or Smirnoff because they don't need to. They don't need to impress their friends. They're not out to the bars and restaurants. And it's fascinating how things are changing. I mean, Estee Lauder, long called a wonderful quality stock. Well, they generated a substantial part of their revenue from duty-frees and duty-free traffic. And now when you're sitting at home and you're not going out as much, do you need makeup as much? So things are changing.
We got a lot of questions to get through, Sean. So perhaps we can answer, or you can answer them as quickly as possible. Paul Fallon says, do you believe there are many value opportunities on the Johannesburg Stock Exchange?
Well, that's a good question. And I don't, to be honest, I don't spend a huge portion of my time looking at the South African stocks because I have a global remit, and the JSE makes up a very small component of the global exchanges. I think I think the gold stocks, and I mentioned Sibanye earlier, I think those are interesting. And I think that Harmony did a very good deal buying the assets from Anglo Gold, and with the weak rand and the stronger gold price, I would expect those earnings to be strong. And it's interesting how things change, because how many people a few years ago would even think about looking at a gold stock or gold company, and yet here you have Warren Buffett now buying Barrick Gold in recent months. So things do change, and that for me, all I would say is try and focus on companies where conditions are improving, because if they're deteriorating and a company has a lot of debt, they might run out of rope. They might just not make it through to the other side of the cycle. and that's a concern.
But I have it on good authority from Omaha that Warren Buffett bought into Barrick because a South African runs it.
That could well be true. Mr. Bristow.
Well, actually from KZN, even more specific if you want to get that way. Chris Edwards says there are approximately 8,000 active managers, and I don't have it on good authority, by the way. I have it on no authority. It was sucked out of the air, that one. There are approximately 8,000 active managers in the US, but Buffett says the biggest problem he has with active managers is he doesn't know how to select the next Buffett. Therefore, isn't the selection of a manager as much of a gamble as selecting a stock, and maybe harder, as we all can sensibly do, is just chase their history?
I think that's absolutely right, and I think that's a very good question from Chris, and I think that is why it is more important more important rather than just looking at the historic numbers and which one has done better and just trying to bet on the racehorse that won last week's race, is to understand what they do and how they think. And so what we try and do in our fact sheets is write stories as to what is the background, why do we like eBay, why do we like Kroger, what is our thinking? And if people think that makes sense, great. And if they're worried that we underperformed the market over the previous month or year or whatever, well, then that's fine. But that's not how we think. We're not trying to bet on yesterday's winner. And so I think it's very important. You need to understand how your manager thinks and what their process is, and then make sure you understand it and agree with it.
Tebogo Meloa asks, looking at South African banks, most people say they currently offer value. Would you say the same thing about Capitec? It's still way too expensive compared with the other banks, Tebogo reckons.
Well, I mean, interesting question, Alec, and we can go down a rabbit hole here. I remember Corky Koeman, I think it was, I'll credit him with this. He's a fine man, so if it's wrong, he still deserves credit anyway. But I think Corky once told me that banks are geared plays on economies. And I think that that's absolutely right. And so the challenge with banks around the world today is that economies are under pressure. And that's going to make it more difficult for people to pay back their loans. They don't have the capacity to take out new loans, car debt, credit card debt, home loan debt, etc. And so when I look at Capitec, and historically the profile has been at the more challenging end of the market. I know they take deposits and they've got fantastic technology, etc. But if I can go and buy Commerzbank, which is the second largest bank in the world's fifth largest economy in Germany, for not much more than the value of Capitec, I'd probably, who do I want to bet on? The South African consumer or German industrialists? I'd probably think I'm a little bit safer with the likes of Commerzbank. So we don't own Capitec, no, and I wouldn't be looking at buying it either.
That's quite a stat, that Capitec's worth almost the same as Commerzbank.
It was worth more a year or so ago. I haven't got the current numbers to hand, but it was certainly worth more.
Wow. Benny Kukumur, his question is Rand-based investments recommended? Are Rand-based investments recommended at this point in time?
Well, as long as, it depends, I can't answer that question because I don't know the individual specifics. And I would just say that in the current climate, with exchange control and where they are, and the ability to move money rather cheaply around the world, one should pretend you're a Swiss investor and say, if I'm a Swiss investor, how much money would I allocate to any particular region? And that's not saying anything about South Africa, it's the UK as well. Would I want to have 90% of my money in UK stocks if I'm a UK resident? No, you don't have to live in the same place as your money is invested, is what I would say.
I've just switched off my camera, not because I don't think I'm pretty anymore, but because we seem to be losing a little bit of the bandwidth there. So Sean, Chris Edwards says he agrees with your book. Thank you for recommending it. Mark Foster asks, what is your view on investing in the S&P 500 and or Berkshire Hathaway as diversified investments?
Well, all I would say about the S&P 500 is that about 35% or so, one needs to look a little bit deeper because the information technology sector excludes the likes of Google and Facebook, which come under the communication services sector, and excludes Amazon, which come under consumer discretionary. And so if you look through all of that, you've probably got about 35 to 40% invested in technology-related companies. And as I tried to show earlier, those companies have moved a lot, are priced very expensively, and I think that the future is going to be more challenging than the past has been. So you know, that is how I'd answer that question. You might think it's diversified, and it certainly is with 500 companies, but maybe a better way, if you wanted to go down the ETF route, is an equal weighted S&P 500, where you don't have the same weighting in those large companies.
Grant Tar wants to know, what is your view on, sorry, my apologies. Do you have views on Tencent? Process. Nice first. You do. Come on, tell us the truth. Sell at the market.
Well, I certainly do. And if you actually have a look, I have written some articles historically on LinkedIn and in fact with BizNews on Naspers and Tencent. Look, they've done remarkably well. That was just probably goes down as one of the best investments ever in the history of investing out there, is the money that they put into Tencent and what it's worth today. What worries me in this era of global political turmoil is that with Tencent, it is a Hong Kong listing of a Cayman Islands company. And the Cayman Islands company doesn't actually own the underlying assets. They have a contract with the underlying Chinese companies, which are owned by Mr. Ma and the chief technology officer, etc. And that's no different for Tencent to Alibaba, etc. So what I don't know is what would happen if the management fall out of favor, or China changes the rules, or something happens in the Cayman Islands, or worse still, something happens to Mr. Ma. You've got a whole lot riding on a flaky legal agreement that, by Tencent's own admission in their 20F, may not be legal under Chinese law. So that is my concern, and it concerns me greatly that such a large percentage of South African savings market is invested in Naspers. And in fact, what's also interesting is the process, from what I've seen, hasn't really unlocked much value. And I know there's the big growth story about food delivery. I fail to see the merits in those. I can go and buy a pizza from Waitrose for £4.50. Or I can, buy one from Mr. Delivery or Deliveroo or one of those companies, pay £16, or wait 40 minutes for a soggy pizza to arrive at my door. So, for me, it doesn't sort of add up. And I would far rather, from a South African savings perspective, that Naspers continue to sell their shares in Tencent, to buy back and process, and to buy back their own shares on the JSE to unlock the value for the South African savings market. And so that's what I would prefer.
Rob Oakley says, I think there is so much debt in the world that it is unrepayable, and the likely outcome is either default or inflation. So is it prudent to have some gold or gold shares as investments? Your view, Sean?
Well, I think, those debt numbers are just staggering, and they're going up all the time. And I think Rob's absolutely right. It's unlikely to be repaid. And I do think default is going to happen in many industries around the world. And that's what we've got to be very careful of as investors. Focusing on the balance sheet is absolutely critical. Do I think that there's merit in holding gold? I do. And forget about what I think. Investors around the world are putting money in gold ETFs, and it was interesting for me just a few days ago, on the 21st of September, 1 million ounces of gold was that was the investment into ETFs. Now that's a substantial portion of the annual production of one of the largest gold companies, and that's in one day. So the gold market, if you add up all the value of the gold companies together, I mean, it's going to be less than Tesla. And if you look at the profits that those companies generate, it's substantial at these prices. And if you look at where the wealth is moving, maybe the wealth is moving from the west to the east. And where is gold revered? It's revered in the east. And so I think it does merit having a little bit of your wealth invested in gold. That's what I think, but I could be wrong. And we certainly have a percentage of our portfolio invested in gold companies for that very reason.
You're always going to make people happy when you go for gold. And it's a South African audience, Sean. Well done. Nice one there. George Ware asks, he says, Sean, when investing in different markets, how do you handle the currency risks?
Well, many of the companies, now that's also a very good question. I mean, we are globally diversified. And so when you do buy eBay, which is listed in the US, you do get some European exposure. Similarly, when you buy Ahold, which is listed in the Netherlands, they own assets on the east coast of the US, food retailers there. And so you're going to get some currency exposure from that. So we don't hedge out the currency exposure. We just know that we're buying these global businesses all have their own currency exposure. And so we're getting a melting pot of that. And that provides diversification for us.
Anthony Jackson asks a question that I think you have already answered. Comment on NASPAS. Do you want to add to it?
No, I think I've said all other than I really encourage NASPAS's management for the sake, there's this concept of stakeholders these days, Alec, which is more than just shareholders. And I think that NASPAS has a responsibility. All companies have a responsibility to stakeholders, employees, retirees, etc. But NASPAS has a huge responsibility, and that is to the savings industry of South Africa. And in the interests of the savings industry of South Africa, they must unlock the value. And so that's what I would encourage them to do. And I know they tried via process, and I know they sold a few shares, historically in 10 cents, and then committed not to sell those shares again for the next 3 years. But I would, in the interests of the savings industry of South Africa, I think they should unlock value and return that to shareholders by buying back NASPAS. And I say that we don't own NASPAS in the fund, and we don't own 10 cents. So I have no vested interest whatsoever. But it's for the sake, other than, because if something, we saw the damage that happened when something went wrong at Steinhoff, and that was 2% of the index. NASPAS is a lot larger. And who knows, anything could happen up there these days with what's going on in China and the US and etc.
Yeah, NASPAS over 20% of equity-based savings in South Africa. Do you think that the 50% discount at which NASPAS is currently trading would motivate a lobby group to say unbundle the process shares, or if you like, let process unbundle the 10-cent shares, given its impact on the South African economy if something went wrong?
Well, I think we've had that historically, but the NASPAS management, look, I mean, and all credit to them, because we wouldn't, they have done a huge service to the savings industry of South Africa. So, it's been a remarkable winner. If you look at what stock markets in many other emerging markets have done, Brazil and Argentina and places like that, they haven't had a 10 cent to really help them through this crisis. So they've done I don't want to just throw punches at NASPAS's management. They've done a remarkable job. But maybe now is the time to unlock that value. That's what I would suggest, especially at a time when people are drawing down on savings, drawing down on pensions right now. If that doesn't happen, then pensioners are getting shortchanged. But they have a control structure in place, which has been pretty watertight. And I think I'm right in saying that historically, US hedge funds have tried to do that and tried to form lobby groups and lobby management, etc. But that hasn't worked. And so that's the problem. That route has been tried. And I mean, I think I'm right in saying that the non-executives of NASPAS earn more than the non-executives of Microsoft. And so, maybe there's a problem there too.
Indeed. Gideon XDN has just sent through to us an interesting debt website. Stu, if you could maybe post that one on the chat column. And then James Winch, final question: do commodities resources in general present significant future value? That's a good one to end off with.
That is a good one to end off with. And that depends on which commodities. I mean, it's quite interesting that copper, normally in the past, they used to talk about Dr. Copper with a PhD in economics. And if you wanted to know what the world economy was going to do, you just look at the copper price. Maybe that's become a little bit detracted from that because copper is used extensively in renewables. You think of the wind turbines and the solar, etc. There's lots of copper usage there. And copper's harder to find these days. It's in hostile environments, etc. And so the outlook for copper would arguably be far better than the outlook for thermal coal. So it depends on which commodities you're talking about. And that's why I think one needs to get a little bit specific. But the benefit of some of the gold companies is that copper is often a byproduct. And so you're getting a little bit of exposure to that as well.
Sean, it's been such a pleasure talking with you again in this public forum, and I can see from the number of questions. Sorry, guys, we've reached the witching hour now, so we're going to be turning off. But there you've got Ranmore Funds is. You found it. You found the notification from Microsoft. They do sneak those in, don't they? Anyway, there's the disclaimer, which basically says what, Sean? What's this all about? This disclaimer here.
Basically, I mean, that's every fund manager's disclaimer. You know, the past is no guarantee of future returns. People ignore that, but sadly, that is true, and that works both ways.
Well, you've had a few people saying thanks as well for the webinar today and for sharing your insights with us. We look forward to the next time. Sean Peche, as you can see, is the proprietor of Ranmore Fund Management. Even though he does come from South Africa, so that makes him a very warm guest in our studio, and lovely to have you, Sean, and on behalf of all the people who are here today, thanks again. Until the next time.
Thanks so much.
Cheerio.
Thank you very much, Alec, to you and all your viewers.